Hey everybody, this is Gregg Gossett from Gossett Trading and Mentoring, and today is Saturday, April 22nd, 2023. Appreciate you coming by and watching this weekend's edition of the Gossett Trading Weekly Review. In the podcast today, I am going to, let's start with the whole format. First of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily and the weekly charts. We're going to talk about when I bought them, why I bought them, what the signals were, why I entered them, and as always, most importantly, how I am going to manage the trade going forward. After that, we are going to do a little bit about trader psychology. Always the most important skill in trading is the ability to create a plan and follow the plan without letting your emotions get amplified either because of losses or gains. After that, we're going to talk, or we're going to do a poem from my good friend Frank. He's a great trading poet. His poems are about trading, always pertinent, good information. And then after that, I have gone down through my watch list, my master watch list, both on the daily and the weekly charts. And I'm going to identify some trades and some levels that I'm looking at for next week. Most of the time, when I'm looking for trades, they either have to go higher or lower for me to get interested. Some kind of level to the downside that rejects, gives me a good risk to reward ratio, or we have to have some type of upside momentum to get into a momentum trade. But as always, patience is the most important part in trading, just waiting for those levels to materialize before making your entry. I've had some great trades last week, had some great trades this year, and if you've been watching the podcast on a regular basis, you'll see that some of the best trades I've talked about 2-3 weeks before they got to those levels, and those levels worked, giving me a good risk to reward ratio, position sizing correctly, placing my emergency stops, placing my end of day stops, knowing when I'm going to have some overhead resistance. And then, as you know, I always take partial profits on the way up and start phasing out whenever the market has some gains for me. So we'll go over all that. I hope this podcast has been helpful for you. You know, it's always helpful for me to prepare for this podcast because I'm preparing for the podcast, but I'm also preparing for my own trading for the next week. But it was a great week of trading for me. I have added some shorts. We've gotten pretty high here on this big rally. And last week, did I take some shorts? Yeah, I definitely took some shorts. I think both on silver. Well, I have them here. We'll go over them. But we're having a little bit of a pullback, starting to get me a little bit more bullish, but I still need to wait for those actual signals. So we'll go down through the dailies. I think I have 8 potential dailies that I'm looking for. Some of them are not even close to where they need to be, but I've identified the level that if and when they get there, then I will take the trade. And then on the weeklies, the same. Remember, weekly trades happen on Friday because that's when the bar closes. All right. So hope everyone's doing well. Hope your trading has gone well. Hope you're having a good weekend. And I hope by coming here and watching this podcast, investing the time in this podcast, that it's helpful for you and giving you an idea of how I look at levels, how I position size, and that's what we'll look at today. So first of all, I have to run that U.S. legal disclaimer. Hang tight for about 40 seconds, and I will be right back. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Well, thanks for sticking through that with me. All right, so let's get on to the daily trades that I have, the daily swing trades that I have. As usual, what I'm looking for some kind of support that holds if we're talking to the downside, and most of these were to the downside. So I'm looking for a major level of support For instance, a 300 daily moving average, 250, 200, 30 RSI, and as always, I like to look for combinations or confluences of indicators lining up. The more indicators that you have lining up, the more entry signals that you have along with the support, the better chance that you're going to have a profitable trade. So let's start with DIA, which is the Dow Jones Industrial. I did get long here back on the 28th of March with this rejection of the 200-day moving average. You can see 2 days before we closed under, then we closed over, we held it. I didn't take it on that day, but the next day here I took it because during the day we went under the 200 and then we closed above it, giving me a very good risk to reward ratio. And probably a good time to mention that on my swing trades I wait for the end of the day. The end of the day prices, in my opinion, are the most valid prices to take. The large financial institutions come in at the end of the day in that last hour, and in particular in the last 10-15 minutes, and the closing price, in my opinion, is the most valid price, most valid price of the day to make your buying and selling decisions. So that's what I do. I wait for the end of the day to make my decisions. But anyway, got long here, 323.90. Now, as soon as I get long, well, as soon as I see my entry trigger, I have to decide how many shares to buy. All right, that's the very, very first thing. Once you see your trigger, once you see rejection of some kind of level, then you have to decide, okay, how many shares am I going to buy? And that is a function, everyone, of volatility. How much volatility is going on in the market. And it's very easy to do this. I use a 2 ATR value, average true range. 1 means that's the average range. 1 ATR is the average range of the day. That's what's expected. For my emergency stops and my position sizing, I like to use the value of 2 ATR. So that's 2 times the average daily range. And it's all a function of your account size. So for the podcast today, let's just use the hypothetical $100,000 account. So if I have a $100,000 account, 1% is $1,000. If I have a $50,000 account, 1% is $500. If I have $1 million, right, it's $10,000. So what I do, let's use the hypothetical $100,000 account. 1% of $100,000 is $1,000. I divide that by the value of the 2 ATR on the particular day. All right. So $1,000 divided by 568, if we were doing it today, divided by 568, that tells me to buy 176 shares. It's based upon the volatility of the last 20 days. And if you're in a low volatility market, then you should buy more shares. If you're in a high volatility market, you should buy fewer shares. Okay. If the volatility was of 1, for example, and you're buying 100 shares, okay, fine. But let's say the volatility goes up to three times. Well, if you're still buying that 300 shares in 3 times volatility, it's like you're buying 900 shares. So if it's 3 times volatility, then you should only be buying 33 shares to compensate. So that seems complicated, but the math, the 2 ATR does it for you. So 1% of your account value, the way that I do it, hypothetical $100,000, 1% is $1,000 divided by the value of 2 ATR. That shows me exactly how many shares to buy based upon the volatility. So now I know, okay, I'm going to buy 176 shares. Then I have to place my emergency stop, and my emergency stop is just the value of the 2 ATR, the 568 below my entry, because I just did the math, right? So if I have 176 shares, and it goes down 568, and then you can see I drew my line here. This is exactly the 2 ATR value below my entry point. Then I lose that $1,000. That makes sense. So I know, regardless of what the percentage move is, that if I do hit my emergency stop, that I will get out, and I know exactly how much I'm going to lose. Right now, am I going to use that emergency stop? Is that going to come into play very often? No, it's only going to come into play about 5% of the time. The other 95% of the time, if I have a losing trade, it's just going to be my end of day stop. So I always have two stops. I have my emergency stop, right? Take my hypothetical $100,000, 1%. $1,000 divided by the value of the 2 ATR. That shows me where my emergency stop is, where I'll lose that hypothetical $1,000. But my end of day stop, 95% of the time, that will be my loss, and it will be much less of a loss than my emergency stop. So why did I take the trade? I took the trade because it rejected the 200-day moving average. Got long here at 323.90. If it had just closed below the 200, then I'm simply out for a very small loss. See, that's the key with profitable trading, everyone. Identifying a support level that gets rejected, position sizing based upon the volatility, like I taught you with the 2 ATRs, placing that emergency stop 2 ATRs below, and then end of day stop if it closes below the 200 or the 300 or whatever line you use, then get out for a small loss. Now, so I've only talked about losses first, right? Because it's the most important part is managing and position sizing correctly. So if you have a loss, it's a small loss. Now to the upside, I place a trailing stop level 1.5 ATRs above my entry. If it gets there, now I go into what is called trailing stop mode. Now, with trailing stop mode, once I get to trailing stop mode, if I have a close below a previous bar's low, then I get out of half. And then if I reject the 70, I'll get out of another half. If I have a close below previous bar's low after reject the 70, then I'm completely out of the trade. And in this particular trade, I'll show you if I ever get to a 65 RSI level and have a close below the 5, then I just get out of the entire trade. So I know this sounds like a lot of rules. And, I've been trading for 28 years, and I firmly believe this, that the difference between people that make money and lose money in trading is how they manage the trade going forward after they've entered the trade. And so I have a lot of rules based upon as it moves up and when to get out. And I do my best in this podcast to explain these. If after the podcast you're left going, I don't think I quite understand those rules, I don't blame you, because I have a lot of them. And if you would like to learn exactly how I trade, if you would like me to teach you step by step all the rules that I use, I do offer a one-on-one course available in the evening time via Skype. It's a very intense course. It's 15 hours. It's just you and I. I teach you the 5 different trading approaches that I use, and I teach you step by step all the rules. And when you're done with that course, you're going to know them and you're going to have a skill. So if you are interested in doing this course with me, all you have to do is send me an email. Email is in the link of this YouTube video, and it's an investment in yourself. It's an investment in learning a skill, but I'd be very happy to work with you. So send me an email if you're interested. We can talk, get things started. All right, and I will teach you all the rules. So that's why I was explaining it. There are a lot of rules here, but it's worth it, right? Nothing comes easy. Trading is not that easy. You have to have some rules. You have to have some if-then statements. If this happens, I'm going to do that. If that happens, it's going to do this. So back to the trade. Took the trade here with the rejection of the 200, 323.90. I position size correctly. I placed my emergency stop. I know what my end of the day stop is. I placed my 1.5 ATR trailing stop above. Now, whenever it moves the value of 0.45 from the previous day's close, I always take off 10% of the position. I like to sell into strength. The stops, the end of day stops, the emergency stops, this is all defensive moves. Trailing stops, defensive moves. But offensive moves are taking partial profits as it moves up. And that's exactly what I did. So like any great sports team, you need to play offense and defense. And in trading, I believe the same way. So rejection of the 200, 323.90, starts moving up, start taking partial profits, get to my trailing stop level. Now I'm in trailing stop level, which means if I have a close below previous bar's low, I will get out of half. Never happened. Here moved up, stopped moving up, sideways consolidations, no profit targets, moved up again, more profit targets, more profit targets, more profit targets. Never made it to the 70 RSI, but once I get to a 65 RSI level, then the 5 EMA comes into play, and if I have a close below that, I exit the position, and that's what happened here on the 19th of April. So great trade, perfect example of position sizing, having a very close end of day stop, and scaling out into strengths. Up here we got above the 65 RSI level, and then we finally closed below the 5 EMA, and that's when I got out of the trade. Beautiful trade, up 4.41%, and I am out. And so far that has been a good decision. All right, let's go over to Home Depot. Interesting trade here on Home Depot, and it really highlights why it's important to have trailing stop methodologies, why it's important to take profits when the market gives them to you. I got short here, Home Depot, back on the 4th of April. Why? Well, the previous day it closed above the 200-day moving average. Next day it moved up, but closed dramatically lower than the 200-day moving average, and it also triggered a V1 entry trigger, bearish V1 entry trigger to the downside. Now, if you would like to learn more about V1s and V2s, I use them in my trading. They're the bread and butter of my trading because they make any trade better. If you go to my YouTube channel in the lessons playlist, I have a video there called V1s, V2 entries. You can use them both for bearish and bullish trades, but this was a bearish trade. V1 consists of two bars, bar 1, bar 2. Bar 2 goes above bar 1's high and then closes below bar 1's close. That's bearish, and in addition we rejected the 200-day moving average. So I got short here at 295.10. I position size using the 2 ATR. I place my emergency stop 2 ATRs above my entry point. My end of day stop is, since I'm short, is a close above the 200-day moving average. I also placed my 1.5 trailing 1.5 ATR trailing stop level below because I'm short. So I got short here at 295.10. Next bar goes my way in a big way down. I hit two profit targets. I took off 20% of the trade, locked it in, right? The market can't take it away from me. Next day, down more, took more profits, locked more profits in, and it got to my trailing stop level. So if I'm bearish and I have a trailing stop level, I'm going to get out of half if we have a close above a previous bar's high after reaching trailing stop level, and that's what happened on the next day here, 291.20. And at that point, I locked in half the whole position for a 1.28% gain. All right, so lock that in, reduce my risk, reduce my position size. Then we started to go up. No good, no good. I thought, oh, we're going to close above the 200, but we didn't. We reversed back down strongly, hit some more profit targets. Next day was weak again, took more profit targets off, reduced my position size, and then ever since then we've gone up, 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 and the remaining shares here finally did close above the 200-day moving average, and I took a loss of 1.28%. But did I really take a loss of 1.28 on the trade? No. I made money on the trade still because of taking off when the market gave it to me. That's the offensive part. 20% here, another 10% here, another 10% here, another 10% here, locked in half at a profitable level because it reached my 1.5 ATR trailing stop level, and then it closed above, right? So yes, on the remaining shares, I lost 1.28%, but overall I made money on this trade. So again, right, sounds kind of complicated, trailing stop levels, blah, 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 but that's what I teach in my course. But anyway, out on the remaining shares of 1.28%, but still a profitable trade nonetheless because of taking offensive profits when the market gave them to me. All right, Caterpillar. All right, here we go. I bought Caterpillar all the way back here on the 10th of April. Why did I take it? Confluence of signals, close under the 200, over the 200. That's the main signal. Also had a V2 entry signal. Bar 1, bar 2 goes below bar 1. It's low. Bar 3 closes above bar 1's close. So a nice confluence of signals there. Position size, place my emergency stop 2 ATRs below. My end of day stop is simply a close below the 200. In addition to that, by the way, beautiful double bottom bullish divergence. Look at this low. See how deep these bars are? Then we rally into some green. Then we come down. We're lower than this low, but look at the level of the red MACD bars. Not very much. What does that mean? It means the momentum to the downside is waning. We're running out of sellers, and the implication of that is that we're going to be moving up. Right? The main signal I took was the close under 200, but the associated contributing factors were the V2 and the double bottom and the bullish divergence. Again, more signals, the better. So I got long here, 213.68, placed my emergency stop 2 ATRs below. My end of day stops closed below the 200 SMA. 1.5 ATRs above is my trailing stop level. Of course, while it moves up, I take off profits. So I got long here, 313.68, moved up, took some profits. Next day, nothing, moved up again, took off some more profits. After that, we get to trailing stop level, which means now I go into trailing stop mode. I sell half if I have a close below previous bar's low. That happened on Thursday. See, we got to trailing stop level, then we have a close below previous bar's low, locked in half for a gain of 3.29%. And then the remaining shares that I have at a profit of 3.01%. So really, really good trade. Of course, my end of day stop, if it comes down, closes below 200, I will get out. If it continues to move up, I will continue to take partial profits. If we get to a 65 RSI level, then the 5 EMA will come in play. If it keeps moving up, rejects the 70 RSI, then I'll sell half of the remaining shares that I have, and then to exit the entire trade after rejecting the 70 RSI, if I have a close below previous bar's low after rejecting the 70 RSI, be completely out of the trade. But very good trade here, locked in half for 3.29%. The remaining shares I have up 3.01%. Disney. All right, this is the short position. I did short Disney back on the 18th of April. Here's your 200-day moving average. This is acting as resistance. At this point, we came up, we tagged it, we bounced, couldn't get above it. I got short here at $196. I position size as always, place my emergency stop 2 ATRs above. Where would be my end of day stop on this when I'm short? Well, I bought it because it rejected, could not get above the 200. So therefore, if it closed above the 200, I would get out. Luckily, it went my way. Next day was down hard. Took off partial profits as that happened. Next day down again, locked in more partial profits. Now we got to trailing stop level here. So now if I get a close above a previous bar's high, I will get out. Well, that happened on Friday, right? Here's my trailing stop level. Then we moved up. This certainly closed above this high. So I locked in half at for a 1.61% gain, and I still have half, which is about the same gain. The other thing I wanted to point out here was I like to look at multiple time frames. Yes, on the daily, this made sense. Bounced, couldn't get moved up here, bounced up here, then bounced off the high of the 200. Here you can see here's the dotted line. And it's inside this big down bar, which of course also comes into play. But I also like to look at the higher time frame. So here's my level, right? 196. If I look at the higher time frame on the weeklies, that coincided with the 50-week moving average. So there was resistance both on the daily with the 200 and then on the weekly also resistance of the 50. So again, with almost every trade I take, everyone, I want to see multiple confluences of indicators lining up on the trading time frame, but also on the higher time frame. It will just help you have a better chance of having a profitable trade. And when we go through the potential signals for next week, I'll highlight how there is support or resistance on multiple time frames. So the locked in half at 1.61%, and it's approximately what I have on the other half. So nice profitable short trade there. All right, let's go to the weekly trades. All right, weekly trades happen on Friday. I did buy Tesla back here on the 10th of March, we came down, we rejected the 200-week moving average. I position size, placed my emergency stop 2 ATRs below. My end of week stop is a close below the 200. Never happened. Got long here, 173 even. Next bar moved up, took some profits off. Next week's bar moved up, took some more profits off. Next week bar moved up, took some more profits off, did not get to trailing stop level, then it came back down. Now, I got out here at 180.37 and now it's 165.08. And you might ask, well, why did you get out, Greg? Well, I got out because of earnings. I never hold through earnings. It doesn't matter if I'm in a monthly chart, a weekly chart, a daily chart. I do not hold through earnings. Holding through earnings is one of the best way to put yourself at a major risk. Yes, it's a way to make a lot of money quickly if the earnings are good and the market goes up, but it's also a very good way to lose a lot of money if the earnings are not good and the market does not respond well. And our job as traders is really risk management. We need to focus on risk first, not making a lot of money, but controlling risk, and holding through earnings is one of the worst ways to do that. So before the market closed and before Tesla had earnings, I got out, locked in a gain of 4.46%. Good thing I did, because had I not, I would be way underwater on the trade. So again, do not hold through earnings. That's why I got out and locked in a gain of 4.46%. IWM. Okay, I have been in this trade for a hot minute, but this is a really good example of why it's important, in my opinion, to take profits when you have them, why it's important to have a trading process involved with trailing stop rules. I got long IWM all the way back here. These are weekly trades, right? So they're going to be longer, on October 14th, 22. Why did I get in this trade? Well, on a weekly, see the orange line? This is the 300-week moving average. During the week, we went far below, then we closed above, giving me a very, very good risk to reward ratio. So I position sized using the 2 ATR. I placed my emergency stop exactly what the 2 ATR is below. My end of week stop is just the opposite of why did I take the trade. Why did I take the trade? Well, because it rejected the 300-week moving average. Therefore, if it had closed below the 300, I would just get out, hopefully, for a small loss. So rejection of the 300, proper position sizing, emergency stop 2 ATRs below, end of week stop just to close below the 300, place my 1.5 ATR trailing stop level above. As always, if it moves up the value of 0.45 ATRs, I take off a partial profit. So the next week moved up, took some partial profits off. Next week moved up again, took some more partial profits off. Got to trailing stop level. Doesn't mean I do anything. It just means that if I now have a close below previous bar's low, I will get out. Had another nice week up, took some more profits off. Now, this week here was the first week that it closed below the previous bar's low. So what do? Whatever I have remaining, I take off. I did that, locked in a 6.3% gain on half. Moved down, I thought, ooh, might close below the 300-week moving average. Never did. So I'm stayed in the trade. And then we have another huge month and a half up, whereas it moves up, I take partial profits, take partial profits, take partial profits, right? Reduce my position size, reduce my risk while the market's giving it to me. And then we move back down. We almost close under the 300-week moving average, but we have still held it. So I am still in the trade. And on the remaining shares that I have now, this particular trade up 5.96%. So that's worked out really well. XLF, all right, here we go. Same thing. I was looking for some kind of rejection of a major level below. Well, I entered this trade long here on XLF, financial ETF, with a rejection of the 250. I got long at 30.71. I position size correctly using the 2 ATR. I place my emergency stop 2 ATRs below. My end of week stop is just simply a close below the 250, but it held. I placed my 1.5 ATR trailing stop level above. And as it starts to move up, I start taking profits. Next week moved up nicely. Took off some profits. Next week didn't do much. Next week moved up again. took some partial profits off, got to trailing stop level. So now I'm in trailing stop mode, but I'm going to sell half if I have a close below previous bar's low. Has not happened, so I am just hanging out in this trade. This trade's been a good one. Great one. This is up 7.65%. All right, Boeing. All right, I'm an equal opportunity trader, so this was to the downside. Why did I take this short on Boeing on the weekly? Well, okay, we rejected the 200-week moving average. We have a V1 to the downside. Here's bar 1, bar 2. Bar 2 goes above bar 1's high, closes below bar 1's low. That is a lower high V1. This V1 came lower than this high, and we rejected the 200-week moving average. That's why I got short. I got short at 212.40. I placed my position size. I placed my emergency stop 2 ATRs above, and then my end of week stop is a close above the 200. Okay, after shorting at 212.40, moved down strongly, enough for me to lock in some profits. Okay, not to trailing stop level yet, and this week rebounded a little bit. This particular trade currently in the money, 3.55%. Now look, I have earnings on the 26th. So I am going to have to get out of this trade before earnings. Doesn't matter if I'm still in the money or if I'm out of the money. Doesn't matter. I'm not going to hold through earnings, just like with Tesla. All right. So if earnings are great and it goes ripping up, I do not want to be part of that. Right. So I will exit this trade, even though it's a weekly trade. I will exit this trade before the earnings come out. But currently, this short position in the money, 3.55%. AGQ, another short trade. Now, why did I take the short trade on AGQ, which is double leverage silver? Okay, we rejected the 200-week moving average. It did not want to go higher than that. I got short here, 34.60. Remember, I like to look at multiple time frames. So on the weekly here, on the tradable time frame, yes, it rejected the 200. But let's go to the higher time frame, which is the monthly. Were there any levels of resistance above where it rejected? Yes. Look, we have major levels here of the 100 month moving average and the 50-week moving average. Inherently, those are going to act as resistance. And then on the tradable time frame, also showed me that it rejected some resistance, which is the 200. So I got short here, 34.60. My position size based upon the volatility. I placed my emergency stop 2 ATRs above. By the way, if I get up here on that hypothetical, how much do I lose? Even if it's 10, 12, 15% up, I still only lose the $1,000, right? Because that was all I was allowed to lose. My end of week stop, anyone know what that is? It's a close above the 200 because that's why I took the trade. So I position size, emergency stop up here, end of week stop, just simply a close above the 200-week moving average. Place my trailing stop level here. I'm not there yet, but once I do, then if I have a close above a previous bar's high, I will get out of half. And again, this particular trade currently in the money, 3.22%. All right, last trade, and I'll show you exactly how I did the math on this. I took this trade on Friday, as a matter of fact. Why did I take it? Well, look, here's the 200-week moving average. During the week, we went and tested it. There were not enough sellers to drive it down any further, showing me that that level is being respected. So I got long here, 39.92. So let's do the math exactly. Here we go. So hypothetical $100,000 account, 1% of that, $1,000, $1,000 divided by the value of the 2 ATR. The value of the 2 ATR yesterday was 3.91 divided by 3.91. Tells me to get long in this hypothetical 255.7, so I'd round that up to 256. 256 shares. Doesn't sound like a lot, but we're dealing with weekly bars here. Weekly bars have bigger ranges, so we need to buy fewer shares, right? So I buy 256 shares here, 1392. I place my emergency stop 2 ATRs below, 391 below my entry point, because if 391 times 256 shares, how much is that? It's $1,000, right? That's all I was willing to lose on this trade, hypothetically. My end of week stop is a close below the 200-week moving average. My trailing stop level, 1.5 ATRs above my average. And that's the trade. Look, I don't know what it's going to do, but I looked for a level of rejection. I position size correctly. I placed my emergency stop 2 ATRs below. That's my worst case scenario. My second worst case scenario is just a close below the 200. Place my 1.5 ATR trailing stop level above. If it moves up the value of 0.45 ATRs from any previous week close, I will take partial profits. Now, look, earnings are coming up here on the 2nd of May. Am I going to hold through those? No, I am not. I am just taking this trade between now and earnings based upon the price action rejecting the 200 weeks. So this particular trade, currently in the money a little bit, up 0.7%. So let's just do a really quick recap on the dailies. Exited DIA with a gain of 4.41%. Home Depot had a loss of 1.28%. Caterpillar currently remaining shares up 3.01%. Disney the short up 1.61%. Over on Tesla, gain of 4.46%. Lock that in. IWN, gain of 5.96%. XLF, gain of 7.65%. Boeing, the short, gain of, what is that? Yeah, 3.54%. AGQ, gain of 3.22%. And Pfizer, just took that trade, but a gain of 0.7%. So really great trading week. Only one loss based upon those. But, be patient, everyone. Wait for the trade to get to your level. Wait for the price action to show you that it's rejected a level. Doesn't guarantee you a profitable trade, but it helps. And then throwing in your looking at the higher time frame, looking for support resistance level also helps. And again, these are all the things that I teach you in my one-on-one course. So keep that in mind. Consider taking it. You will learn a valuable skill. And, you can see these trades. We've had lots of winners, not a lot of losers. Doesn't happen every week, but it's based upon the preparation and the confluence combination of signals lining up and the multiple time frame signals. All right. So consider it. I know you'll be happy if you take this course. And you'll have a good time, and you will learn a lot of good things. All right, so those are the current weekly trades. Let's do a little trading psychology, shall we? This is the most important skill in trading. Most people don't look at patience as a skill, but I assure you it is a skill. Waiting for the market that you're trading to reject some kind of level, either to the downside or to the upside. All right. So with that said, let's delve in and see what Thomas Paine has to say today. Thomas Paine, one of my favorite channels over on Twitter. You can follow him at Trader T Paine. The interesting thing about Thomas, he came from the scientific community. He was a scientist using the scientific method. And when he decided to start trading, he brought that scientific method with him to apply the scientific method to his trading. So whenever Thomas posts something, I look forward to it, and you should read it because it always has some valuable information. Let's see what Thomas has to say today. Excuse me. Excuse me. I've had a little cold the last few days. Traders get pissed off because they feel like they did all their research and still got it wrong. The problem isn't that they were wrong. The problem is that they are getting angry over an outcome they cannot control. Would you feel dumb if you flipped a coin and called heads but it landed tails? Some things are just out of your control, and sometimes no matter how much you research a stock, the market will surprise you and remind you that you know nothing. It isn't you, it's the game. But if you don't accept this, then the problem will become you. Okay, there's a lot of things to unpack in there, but it's a very well-written post and very accurate because you have no control over what the market's going to do, right? All you have control over are how many shares you're going to buy, And we talked about doing that with position sizing based upon volatility by taking, at least the way that I do it, 1% of my total capital divided by the value of the 2 ATR. That shows me my maximum allowed loss. But then I have my end of day stop or end of week stop as well. So I know exactly my worst case scenario. Most of the time, you could have some major gap through, but most of the time you know exactly what your maximum allowed loss is going to be because it's 2 ATRs below. It's a long ways away. You know where your end of day stop is. You have your trailing stop level. You take partial profits on the way up. So regardless of what the market does, I know exactly what I'm going to do. Regardless, if then statements. If this happens, then I'm going to do that. If that happens, then I'm going to do this. It's a much more holistic way to trade if you have a plan based upon if-then statements. If you have plans based upon rules, good trading principles, either to the upside or to the downside. The missing component is we do not know what the market's going to do, and you cannot take that personally. You just do your best. You position size, end of day stop, emergency stops, taking partial profits. But whatever it does, I know exactly what I'm going to do. Can you say the same in your trading? You know exactly what you're going to do, regardless of what happens. Well, in my experience, I've been trading 28 years. That's the key to profitable trading, is having a rule-based plan. All right. So let's one more time. Traders get pissed off because they feel like they did all their research and still got it wrong. The problem isn't that they were wrong. The problem is they are getting angry over an outcome they cannot control. Would you feel dumb if you flipped a coin and called heads, but it landed on tails? Some things are out of your control, and sometimes no matter how much you research a stock, the market will surprise you and remind you that you know nothing. It isn't you, it's the game. But if you don't accept this, then the problem will become you. So position size correctly, know exactly what you're going to do, regardless of what's going to happen. Don't get upset about it, because if you are using good trading principles, both to the upside and the downside, you are going to make money in the long run. That is your edge, but you need to know. So thank you very much. Please consider following Thomas Payne at Trader T Payne over on Twitter. All right. Let's do a quick poem for my good friend Frank. You can follow Frank over at Franco D. Frank is a great trader. He's a fantastic musician. He's a great journalist, um, um, and obviously poet. Let's see what Frank has to say today. Markets don't always act so hot. Stocks can take a piece of you after you've given it all you've got. You took it on, gave it your best shot. Now shake it off, because being a trader takes a hell of a lot. Perfect. Absolutely perfect, and it's true. Markets don't always act so hot. Tamale. I threw the tamale in, but markets don't always act so hot. It's true, right? There's give and take. Stocks can take a piece of you after giving it all you've got. You can do all your research. You can set everything up perfectly. Doesn't mean it's going to have to work, and it definitely can take a piece of you. You took it on. You gave it your best shot. Now shake it off, because being a trader takes a hell of a lot. It does. If it doesn't work out, you did everything you could. Doesn't work out, you just get on to the next trade. And yes, you will go through drawdown periods, even if you follow your process perfectly. But in the long run, if you have good trading principles, good rules, you have that edge. And in the long run, you should make money if you have that all in place. Trading is a marathon. It's not a sprint. Just look at each trade as the next one of 1,000 trades. Don't get too emotional about any one trade. And that's the key. So follow Frank, please, over at Franco D over on Twitter. All right, let's start with the dailies. These are the daily trades that are on the daily charts that I'm looking for next week. Now, most of the time, they're not going to be where they need to be yet. So this is where patience comes in. AMD. Had a beautiful trade on AMD on the weekly, over a 20% trade. Hit my stop. I got out, luckily, because it has come back down. So I'm looking at AMD for next week on the daily. The level that I'm interested in. Do you see the 300-day moving average? This is the orange line here. This is what I'm looking for. I'm looking for the market to come down, bounce at the 300. Either go down below it during the day, close back above. That's called an intraday rejection, or it close under and it closed back over. So this is the level that I'm waiting for. If it gets here, great, and it does that, I will take the trade. If it doesn't, I will just move on and wait for another market that gets to my level. So here's the orange line. It's about 85, 88. It's a few dollars below where it is, but there should be some buyers that come in there. In addition to that, here's the negative third ATR channel. 92% of prices tend to stop going down or bounce and go up when we get to that level. So we have this confluence here of the 300-week moving average and the negative third ATR channel. Now I drew a green line here because I always want to look at the higher time frame. So the 300-week moving 300-day moving average on the daily is here at the green line. If I go over to the weekly, is there some support on the weekly at that level? I would like it better if it was here at the 50 EMA or the 20 EMA, but it's still inside this big, huge candlestick bar that moved up here. Whenever you have a candlestick or bar chart that moves more than 1.5 ATRs, that's when I like to buy a pullback in there. Oh, by the way, this was the trade that I was talking about. See how we had this big move up? Then we came back down and bounced at the 200-week moving average. This is where I bought it and then sold it up here. It was a great trade, but that's on the weekly. But on the daily 300, which is the green line here, that dovetails within this big bar. It's also within the value zone, green line, anywhere in between here is considered the value zone. So on the weekly, it's not perfect, but I like it because the 300 on the daily is within this big bar and it's in the value zone. So that's what this trade is about. If AMD gets back to the 300 next week with a bounce, an intraday rejection, or a close under, close over, that would be my entry point, giving me a good risk to reward ratio. Of course, I'm going to have to position size, place my emergency stop, all that kind of jazz too. All right. So AMD with some kind of rejection of the 300 next week, potential trade. Gold. All right. Now, this is really interesting. I pointed this out last week. Do you see I've highlighted this blue bar here? Do you see to the left how we have a gap? You see how to the right we have a gap? See how it's kind of floating out here in space? This is called an abandoned baby. And these are very, very strong signals. This is very bearish for gold. And as you can see, it's moved down ever since that's happened. Did I take the trade? No. I am waiting for the price to move back up. If it does, doesn't have to. If it moved back up here to the bottom of this bar of the abandoned baby, this would be a very, very good short area. I don't know if it's going to get there. It may not, but if it does and it rejects this 189 price, I will definitely get short on gold. I place my emergency stop 2 ATRs above. Where would my end of day stop be? You know, this is a trade that I don't usually highlight, but it would just be a close above here, making a new high. So my risk would be from here to here, good risk to reward ratio. But these are such strong signals. I don't know if it will get back up, but if it does get back up and test 189, that will get me short. Intel. All right. Well, look, 200-day moving average right here. That would be my entry point. This is where buyers should come in. Don't want to buy up here, right? Don't want to buy above the value zone. Look, the value zone is between here and here. Most people buy up here. And why do they do that? Because the news is good, headlines are good. They're like, "Ooh, this thing's going to the moon." Well, I never buy above value. Above this green line, I don't buy. I want to buy below value, sell in value, or buy in value and sell above value. Most new traders buy above value and get stopped out back in value, exactly the opposite of what they should do. So this is my level on Intel that I'm looking for, is some kind of rejection of the 200-day moving average. I drew the line. Let's see what that looks like on the higher time frame. The green line here on the daily was the 200. And if we transpose that onto the weekly, look, we have support of the 20-week moving average, and it's in the value zone. So that makes sense. So for Intel next week, if we have some kind of rejection to the 200, that's where I will get long. Philip Morris. All right, well, Philip Morris was way up here. Philip Morris had earnings and it moved down strongly. Just another reminder, it's a good idea not to hold through earnings. Where do you think my level is on Philip Morris next week? That's right. It's the 200-week moving average. It gives me a good construct to construct my trade, a good level to construct my trade off of. So next week, some kind of rejection of the 200-week moving average possibly get me long Philip Morris. I drew the line here on the daily at the 200. Let's see where that dovetails. Not great, not perfect. I would have liked to have had it above this 50 here, 50 EMA and 50 SMA, but it is below the value zone and it is within this V2. See the V2 here, bar 1, bar 2, bar 3. Bar 2 goes below bar 1, bar 3 closes above bar 1's close. It's still above the halfway of the washout bar. My students will know what I'm talking about as far as the stop. So it does make sense. So the dailies have to be perfect, but the weeklies don't have to be perfect. But the more perfect they are, the better. But it's decent. But yes, if Philip Morris gets down here, rejects the 200-week moving average, possible trade. Now, I do want to point out that, okay, would I have 8 signals here? Well, what about if all 8 of them all trigger on the same day? Do I take all 8? No, I don't. I only take one trade per day. I take the best trade per day. So even if all of them trigger, like say Monday, for example, do I get into all of them? No, I get into the one that has the best confluence combination of indicators on multiple time frames. I may have to get out my fine-tooth comb and really decide. And sometimes it is a bit of a challenge. Man, I have 5 here. What's the best one? Well, which one has the most confluences on multiple time frames? Which one gives me the best risk to reward ratio? That's what it comes down to. So Philip Morris, rejection of the 200. The SPY, well, look, here's the 300-day moving average. This would be a decent level. It also dovetails with the 50-day moving average. Let's draw the line there at the 300, 402.80. Go back to the weekly. Well, for one, we're in the value zone. We have support of the 50 EMA and the 20 EMA below, so it makes sense. And I'm expecting actually a pullback. I mean, we have earnings next week, so it could go either way. It really could go either way. And don't buy before earnings. You could really get beat up, kind of off the subject, but don't gamble on those earnings. Just wait for price action to tell you a level's resistance. The first valid level of support on the SPY, and we've had this nice big up move, but having a pullback is to be expected and would be quite normal. So next week, I'm looking for a rejection of the 300-day moving average. UUP. Okay, I mentioned this last week. I did a post on Twitter about this. Remember how we were talking about abandoned babies on gold? Well, look, here's an abandoned baby on the dollar. And the dollar and gold are negatively correlated at this point. So having an abandoned baby to the downside came the exact same day we had an abandoned baby to the upside on the dollar. So look, abandoned baby certainly has gone up since that, as it often does. What I'm looking for is a pullback to the high of that abandoned baby. If it does and goes below it, rejects it, I will get long UUP. These are long-term signals. So having the dollar breakout here is bad for stocks. It concerns me about stocks in the future going forward. But as far as the trade, move down, test the high of that abandoned baby, I would definitely get long. XLE, okay, pretty easy. Dovetail of the 200 day moving average and the -1 ATR channel. I drew the line here. Let's see what that looks like on the higher time frame. Support of the 50-week on the 50 SMA on the weekly. So daily makes sense. The level 200 on the weekly makes sense. Level 50-week below you. So that's what I'm looking for on XLE, some kind of rejection of the 200. Last but not least, healthcare. Here's the 200 again. You might say, Greg, that looks a long way away. I don't know if it's going to get there. Yeah, I don't either. It may not. And if it doesn't get there, I'm just not going to take the trade. But on the weekends, like this podcast, identify the levels that you're looking for and go, you know what? If it got there, that would be my spot. Mark them, write them down. If they get there, then take the trade. If they don't, then don't take the trade. These are the levels that are important. These are the levels that buyers should be coming in. So the buyers right here, we have a confluence of the 300-day moving average and the 200. So this would make sense if it gets there. If it doesn't, who knows? But remember, next week is earnings. We could have some big moves next week. So don't look at this and go, oh, it's impossible that it could get there. Oh, it could. It definitely could. And if it does, I'll take the trade. So real quick recap, AMD for next week, if we reject the 300, that's my potential entry point. Gold, if we rally back up to the bottom of the abandoned baby, 189, and reject, that's my short position. Intel, if we reject the 200-day moving average, that's my entry signal. Philip Morris, if we reject the 200, that's my entry signal. S&P, if we reject the 300, that is my entry signal. UUP, which is $1, if we come back down, test the high of that abandoned baby, that is my long signal with the stop being a close below the abandoned baby. XLE, again, 200, and XLV, 100. And again, if they all trigger on a same day, I'm not going to buy them all. I'm only going to buy one. Those are my rules. That's my trading mantra. I buy the best trade of the day. And who knows? Maybe we just go up and we don't get any of those and I don't have any of the trades. But those are my daily setups for next week. And now let's take a look at weeklies. All right, here we go. Etsy on the weekly bars. The level that I'm looking for is the 300 right here at about 97.90. I've been talking about buying Etsy for weeks and weeks and weeks, but it just hasn't got there, which luckily I didn't buy because it didn't get to the level. Now kind of a pro tip here, when you're looking at a level, and right now we're looking at the 300-week moving average, look back in time and see if that level respected last time. Did it? Look right here. It did reject the 300-week. That's a good sign that in the future it will do so. It doesn't have to, but it's a good sign. I mean, certainly that would have been a wonderful trade with that rejection of the 300. Lots of money to be made up in there, but I am waiting for a rejection of the 300. If it gets there, I'll take the trade. If everything else lines up. If not, I'll just go on to another market. If I do take the trade next week, I'll only be able to hold it for a couple weeks because we do have earnings. But now look, I drew the line here at the 300-week moving average. Let's look at the higher time frame. That dovetails with inside the big bar that was larger than 1.5 ATR. So that makes sense on the higher time frame. So just to be simple, some kind of rejection of the 300-week next week could possibly get me long Etsy. Gold, well, talked about that abandoned baby on the daily. As far as getting long gold, I want it to come down to the 200 to reject that 200. It makes sense. I drew the line at the 200 on the weekly. Let's go to the higher time frame and just inside the value zone, which is good. All right. So if gold pulls back, and we've had a huge up move in gold here, so it would be expected that we have a bit of a pullback, retest that 200. If it does, get me long gold. Indian shares, we had this nice bounce at the intra-week rejection at the 250. Worked out well, didn't take that trade. Now we've come up above the 200. Having a pullback back to the 200 would not be surprising at all and would be a higher low entry, whether it's a 200, 250, 300, 30 RSI. Any higher low entry, higher low V1, V2, always better than a lower low if you're looking for a trend. So that's what I'm looking for. Pullback to the 200-week moving average would make sense. SSO. All right, SSO is double leverage SPY. This upward sloping 200-week moving average makes a lot of sense. I drew the line. Let's see what that looks like on the weekly. Halfway of the V1, my students will understand why that's an important level. So this level here on the weekly makes a lot of sense for support, and that also dovetails with the weekly here at the 200. Now, again, you might say, Greg, that's a long ways away. Don't think it's going to get there. Yeah, you could be right. And if we don't get there, then great. I don't take the trade. But because of earnings next week, it is possible that we get back down there, and that would be an excellent place to enter a trade. Tesla. All right, I know this chart's a little busy because I've already had that trade where I got out before earnings. I really like Tesla here at the 250 on the weekly, about 146, right? So it's about 20 points lower. If it gets there, I do believe that there will be some buyers. There's a big gap here that dovetails with that as well. Drew the line here of the 250 on the monthly. That dovetails where? Inside the V1 bar. So that makes sense. So next week, if we continue down lower on Tesla, if we reject the 250, that is my entry spot. UNG, all right. UNG, in my opinion, is starting to form a bottoming pattern. We did have an under 30, over 30 that failed. We are at a 31.95. What I'm looking for here is another under 30, over 30. And that would be a higher low under 30, over 30. Over here, we had a under 30, over 30, which was a valid signal, by the way. Didn't take that one. But here we're to 31.95. It's very conceivable that we would come down under 30 and then close back above 30, and that would be a higher low under 30 over 30, where this one was a lower low under 30 over 30. And like I just mentioned, any higher low under 30 over 30 or 200, 250, 300, V1, anything higher low is better. So that's what I'm looking for on UNG, is a under 30 over 30. MACD, we did go positive, so there is some bullish kind of green little shoots growing here, but I do believe we are in a bottoming process on UNG. And then last but not least, VIX. Okay, VIX, I mean, look at this. It's gone from $60 to $39.20 after the banking crisis few weeks ago. Look at this down move. It is incredible. But I do believe there's some good buying opportunities in VIX here. Volatility never stays down forever. And from a technical standpoint, look at this low here. Low here, deep red MACD bars. Rally into green. Now we are lower than this low, but look, no red whatsoever. This is called a double bottom bullish divergence with a missing right shoulder. You know, I studied one-on-one with Dr. Alexander Elder. This is his setup, double bottoms, bullish divergences. He believes it's the strongest technical setup in trading, and I would have to agree with him. It is very, very strong. It's just that it doesn't happen very often, but it is happening now with VIX. Double bottom. Look at this low, how deep the red MACD bars are. This low, much lower than this low, yet no red MACD bars. This is called the double bottom bullish divergence, missing right shoulder. Now, just because we have that doesn't mean I take the trade. No, I need to wait for a signal. What's my signal? Well, most likely the signal is an under 30 over 30. We're at a 32.25, so it is likely next week, especially if earnings are good, we go under 30 and then back over 30. That would definitely be my signal. Really like this trade. So real quick recap on the weeklies. Etsy, rejection of the 300 weekly SMA. That is my trigger. Gold, pullback and rejection of the 200 on the weekly. INDA, pullback, rejection of the 200. SSO, pullback, rejection of the 200. Tesla, really like this one. Rejection of the 250 on the weekly. UNG, I need another under 30 over 30. And then VIX, under 30 over 30. And again, if they all trigger next Friday, am I going to take them all? No. I'm going to pick out the best one. What looks best, what has the best risk to reward ratio, which one looks best on multiple time frames. And that's where you have your work cut out for you, is looking for the one, if they all trigger at the same time, looking for the one that makes the most sense with its most entry triggers and the best setups on multiple time frames. And I mentioned at the beginning of the podcast that I do teach a private one-on-one course, a stock trading course. It's a great course, everyone. You will learn a lot. I teach you step by step all 5 of the different trading approaches that I use, all the entry parameters, the emergency stop parameters, the end of day stop parameters, the trailing stop levels, all the rules. I have taught people from all over the world, and I know they've been happy that they've taken the course. They've learned a lot. They tell me so. They give me, great reviews and great feedback. And I love to teach. I really do. Teaching, for me, helps my trading as well. So it's kind of a win-win. Helps my trading, helps my students trading, and it is very important to me that my students succeed. It is extremely important to me. I want them to succeed. I want them to learn this skill. So if you're interested, my email is in the link in the description. All you have to do is send me an email. I'll reply, say, hey, how's it going? Thanks for reaching out. Let's do a Skype call. The Skype call is free, everyone. It's not a sales call. I promise you I'd never do that to you. I just want to learn more about you, what you're looking for, your trading challenges, your trading goals, and it's a great time for you to ask me questions. And when we're done with the Skype call, you can think about it as long as you want. And then one day, if you decide, hey, I really do want to learn this and I really want to study with Gregg, just send me an email. We'll get it scheduled and away we'll go. Now, if you like online courses, I have a great course over at udemy.com, and the link is also in the description of this YouTube video. And I teach you I teach you step by step how to trade the deep dip buy stock trading approach, which a lot of these trades that I've discussed today have been that. In the one-on-one course, I teach you the 4 others, but if you want to get started for a very affordable price, you can buy that course. It's 9.5 hours of video, 15 study guides, 26 videos, and it's only $12 or $15 for the whole thing. I mean, it's like the best money you will ever invest. It is a perfect, beautiful price to get started to learn some good trading principles. So if you're interested in taking that course, and you have 12 or 15 bucks kicking around that you can afford, take the course. I promise you, you will learn so much. And I've had so many good reviews and so much good feedback on that course. Now, if you like today's podcast, I really would appreciate it if you would hit the thumbs up button. Only takes a second. It's totally free, and it really does help out the channel. It lets YouTube know that there's some valuable content here. So if you liked anything in today's podcast and you found it valuable, if you could hit the thumbs up button, I would really appreciate it. And last but not least, and always the most important, please go out and try to do something nice for someone today. If you did one nice thing for a human every day, it really would make the world a better place. And as you know, I am a big animal lover. Grew up with all sorts of animals. They were my best friends. And if you could do something nice for an animal today too, they would appreciate it, and it would be good for you. It's good karma. So I guess the point here is, if you could do one nice thing for a human, one nice thing for an animal each day, it's going to be good for you. It's going to be good for them, and it would just make the world a better place. So I hope this was helpful today. If you have any comments, please leave them in the comment section. I'll do my best to reply to them. I hope you have a good weekend. Hope you stay safe. Get out, do a little exercise, maybe do a little charting, do a little presence work, maybe a little meditation. I know it sounds a little woo-woo, but this stuff is important. It really is. But all in all, just have a happy, healthy, wonderful rest of your weekend. I appreciate you investing your time here, and I hope it was helpful. And God willing, I will be back next weekend, do the podcast. We'll take a look and see how the trades are working themselves out. But, just kind of move to tell you this. Please be careful next week with earnings. We've been pretty high here. If there's any disappointment or guidance in those earnings, we could have a move down. We could move up. I don't know. But we always have to look at the downside first. So just be careful, be patient, wait for your trades to come to you, and follow your rules. All right. Thanks a lot, everyone. And on the way out here, I have to run the U.S. Legal Disclaimer. Have a great weekend. Thanks again for coming by. Bye-bye.
U.S. government stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.